When you look at the real estate market in the US, things are getting a little bit different when it comes to commercial real estate if you compare it to maybe 3, 4 years ago. Quite different.
Yeah.
What's your take on that?
There are a lot of changes for sure. The pandemic pushed a lot of things. Some stuff has happened before and was accelerated. Some trends are going up and down. For example, we were sitting all at home in the pandemic, consuming a lot of stuff online. Amazon demand, e-commerce went through the roof, and we see a little bit of a correction. Housing, especially the multifamily market, is very strong because people want more space at home. They have spent at least 1, 2, or maybe more days at home that they used to be in the office. So they want more space. So you have quite some demand. People were surprised, for example, why in New York all of a sudden the rent growth was so strong. Not so many people came back. There were some people that came back. And so there's some structural changes that you don't have in many places globally, where markets like Miami and Florida, all the Florida markets, are having in-migration that is so strong, and it's easier to move individuals than for a big company, for infrastructure, for housing needs. So it becomes now a time where you have to see the trends, decipher a very complex world, but there are some asset class, especially the industrial and multifamily space, is very prominent and in demand. There are corrections, obviously, on interest rates and cap rates that affect every asset class. But yeah, office is obviously a big topic that we have to work through on the upper end, and we luckily, or smartly, or something in between, have mostly focused on the flight to quality assets on the top notch. The top 5 to 10% of the assets have very good data to show they're actually even better than what they were before, because people pushing up to it. On the lower end spectrum, the more you go down, even if you go down to Class B, you have high vacancies, big questions of how to solve it, some discussions about conversions, but a complex topic. So it's definitely a changing world, and investors like us and others have to be smarter on the operational side, picking very specific locations. So there's a lot of change for sure.
As a foreign investor, Union Investment looks to Latin America, Europe, the US. Which other markets that are similar to Latin America that Union is considering investment at the moment?
So we have obviously a very big presence in Germany and Europe. That's our biggest market. We have been growing very strongly in the US, but not every of our funds, we have multiple funds, can invest in the US based on the fund structure. We have a team in Asia Pacific in Singapore. There are some markets that are recovering nicely, but it's complex because the cities and countries are different. And we have been historically in Mexico and in Chile. We sold out of Chile many years ago. But in Mexico, we have a strong presence, and we believe that the market has good fundamentals, especially obviously on the industrial side, with nearshoring and a new term that I learned recently, friendshoring. It's very interesting, and it's going to continue for a decade.
And what kind of changes would you like to see as a foreign investors in Mexico to increase further your appetite for deploying capital in the region?
I mean, we have been in Mexico for a while, so we understand it. Everybody in the company has been there multiple times. Every asset we own globally, we have to visit once a year with appraisers, fund management, different departments by law to see it, not just a desktop review. And so what helped me over the years in Mexico was that there's a big familiarity with the market. And so obviously one topic that's being discussed in general is security and political stability. It's very hard to gauge and understand out of a headquarters in Germany that covers so many places. But we have good partners on the ground. We have people like me and others that have been active in the market for 1 to 2 decades. Some of those changes are just gradual, right? They're hard to implement. But obviously security, certain things like when the president stopped the construction of a defined, airport project that legally was supposed to happen, is something that doesn't have a very good impact. But we know how to maneuver things, and usually as a core fund, we come in when the deal is stabilized, and we have not engaged too much in development in Mexico. So we weren't that much impacted by those kind of topics.
You mentioned Mexico and Chile. Do you have eyes for Colombia, Brazil, or any other market in the region?
Every couple of years, we're analyzing different countries, which to expand to. What's challenging, we need markets that are US dollar based income so that we only have to hedge euro against the dollars.
Understand.
So, for example, even Mexico, even though we think over a long period the residential market will improve and become more institutional, like in the US, it's peso based, so we can't play in that field because the hedging costs are so expensive. They used to be in the mid 8% range. That doesn't make sense for a core fund. Doesn't make sense for anything almost. And so size meaning we can build up a decent portfolio and US dollar. And it's been challenging because the legal, while it's called Latin America, it's not just the same legal system.
Absolutely.
So the engagement, it was always hard because the engagement with legal text and structuring and travel out of Germany, which is quite far away, has been difficult to justify if we cannot build up a portfolio that has a couple of 100 million within a year or two or three. And so currently we're not planning to expand, but I think when the market improves, Chile was a market from time to time we always looked at again because we like it generally. We had a good experience there. We bought at above a 9 cap and we sold at a 7 cap, so that was great at a peak when the market then had some political topics. But generally, it's a strong economy. So I could see ourselves eventually get back to Chile if the market makes sense. What was hard there is the cap rates went so low that you could get similar deals in the US for similar, because when the Chilean investors were not all allowed to invest outside of Chile.
A lot of money, local money. Then when you look at the real estate cycle, where are the biggest opportunities and what kind of things would keep you awake at night?
So in terms of the best opportunities in the history of my career and also going forward, one of the best deals that we've done are in mixed-use neighborhoods that are improving because even more now than before, because when people spend on average up to 2 days more at home, that means they're 4 days closer to where they live a week. They used to be 2 days closer to where they live. That's almost double. That means consumption of retail, restaurants is increasing where it is. So people mostly don't hate the office, they hate the commute. So when you bring residences closer to the office or the office closer to the residences and create a vibrant environment, I think that will be the locations that will benefit. And within that, if you use the flight to quality, you should get outsized returns to the general market. So I think that's what we're focusing on. And it's a theme, but you obviously eventually have to pick a building. But that's something that we've seen. We looked at a Wynwood multifamily development that made a lot of sense. There's a lot of nice growth. Seaport District in Boston, I invested 6 years ago. There was a phenomenal growth. Almost double the square foot of the area in around 8 years, which is extreme growth. And so that I think what keeps me up at night. The big question is out there of how long will the rates stay high, right? And I think interest rates and that entire question of inflation, how sticky it is, that's the big question that is coupled to so many geopolitical issues. Because we talk about nearshoring is a very good a good thing for Mexican industrial, but it in relative terms makes products more expensive, right? And makes inflation more sticky. So that's the big question, how they're actually interrelated, geopolitical issues to inflationary costs, and inflation is related to how long we will stay in a higher cap rate environment. But I think most research that I read and see are expecting eventually interest rates to come down, eventually construction costs to come down, and when we can continue to create product in areas where people want to be in, which is a mixed-use area or a market that makes sense, a Florida with good weather and good taxes. And so when you pick the right locations, you can offset that risk. But the interest rate environment and the big question of how many more foreclosures will we see on troubled Class B product in any asset class that has to go through the banking system, and how bad will that impact the banking crisis that we already see? It's not just in the future, it's
Absolutely.
already happening. So that's something that definitely keeps me up at night, and we'll have to see how it plays out.
Perfect.